Module Overview. Agribusiness finance refers to the strategic planning, organizing, directing, and controlling of financial activities related to agricultural production, processing, marketing, and distribution. Unlike other sectors, agribusinesses face a highly volatile and seasonal environment influenced by natural factors, biological processes, and global market trends. This module lays the groundwork by providing you with a robust understanding of the foundational principles of finance as they apply to agricultural enterprises. At its core, agribusiness finance addresses how agricultural businesses raise capital, allocate financial resources, manage risk, and evaluate investment opportunities. This encompasses everything from how a farmer finances crop production to how a large-scale agribusiness raises capital for purchasing machinery, establishing processing facilities, or exporting products to international markets. Financial management in agriculture is both strategic and operational. Strategic financial management involves long-term decisions such as acquiring land, investing in irrigation systems, or entering a new value chain. Operational finance, on the other hand, includes daily decisions about paying workers, buying inputs like seeds and fertilizers, and managing cash flow during non-harvest months. A significant portion of this module is devoted to understanding how agribusiness finance differs from conventional finance. 1. Unpredictability. Crop failure due to pests or weather can abruptly halt income. 2. Biological production cycles. These take time and are often out of human control. 3. Market price fluctuations. Commodity prices are volatile and influenced by global events. 4. Seasonality. Income often arrives once or twice a year, requiring careful budgeting. 5. Limited collateral. Many smallholder farmers have limited or no collateral to access loans. Key concepts covered. 1. Nature and scope of agribusiness finance. Agribusiness finance involves all financial aspects of an agricultural enterprise, including budgeting, cost analysis, financial planning, credit access, savings, investment, working capital management, and risk analysis. It applies to all actors in the value chain, from farmers and input dealers to processors, transporters, retailers, and exporters. 2. Importance of financial management in agribusiness. Financial management ensures that agricultural enterprises can sustain production, scale operations, and remain competitive. Proper financial planning allows agribusinesses to 1. Avoid insolvency during low-income seasons. 2. Make informed decisions on resource allocation. 3. Reduce wastage and improve operational efficiency. 4. Analyze profitability of various ventures and crops. Plan expansion, investment, and innovation. 3. Objectives of agribusiness financial management. The main goals include 1. Profitability, ensuring a return on investment that justifies risk. 2. Liquidity, maintaining enough cash to meet daily obligations. 3. Solvency, ensuring long-term financial stability. 4. Risk mitigation, preparing for price crashes, pest outbreaks, etc. 5. Efficiency, making the best use of financial resources. 4. Types of financial decisions. Agribusiness managers must make 3 major financial decisions: A. Investment decisions, what crops to grow, which equipment to buy, or which farm improvements to pursue. B. Financing decisions, whether to use equity, borrow from banks, microfinance institutions, or seek grants. C. Operational decisions, daily or seasonal financial decisions on expenses, savings, working capital, labor payments, etc. 5. Financial planning and budgeting. Financial planning in agribusiness is vital because of the delayed nature of returns. Planning includes A. Projected income and expense statements. B. Break-even analysis. C. Working capital plans. D. Contingency reserves. E. Cash flow analysis. Production cost budgeting. Contextual challenges in agribusiness finance, especially in developing economies. Agricultural enterprises in Africa, Asia, and other developing regions often face acute financial constraints. 1. Inadequate access to affordable credit due to high interest rates, poor financial records, or lack of collateral. 2. Limited financial literacy among rural farmers and agripreneurs. Weak agricultural insurance frameworks. 3. Dependence on informal lenders with exploitative interest rates. 4. Seasonal cash flow crises, especially during lean periods. 5. Gender barriers, where women often have less access to formal finance. 6. Poor access to digital financial platforms and banking services in rural areas. In response to these challenges, digital finance, mobile money, and government subsidy schemes are gradually improving access to finance for farmers and agribusinesses. NGOs, fintech startups, and agritech platforms are also playing a role in simplifying access to credit and financial services. Learning outcomes. After completing this module, you will be able to 1. Understand the meaning and scope of agribusiness finance. 2. Appreciate the importance of financial management to agricultural businesses. 3. Differentiate between agribusiness finance and general business finance. 4. Identify and categorize major types of financial decisions in agriculture. 5. Explain the process and importance of financial planning and budgeting. 6. Recognize the unique financial risks faced by agribusinesses. Begin analyzing financial health using basic tools such as cash flow statements. Thank you for completing the module.